Well, welcome to the Genus video. Today is May 1st, 2018. Time flies. Wayne, just a quick update on what's gone on since our last video in January. From my mind, it seems like the U.S. bond market's really interesting. 10-year government bonds up at 3%. That's a big change. We haven't liked bonds. We've been more in cash than bonds. But what does that tell you when they say the market talks to you? What does 3% U.S. government bonds for 10 years tell you?
Well, I don't think it's to a point yet where it's going to crush the economy or really impact valuations on the equity side. But it's getting up there slowly, and it's been very gradual, and so we're pleased about that. Right now, we're in a space where we're dealing with a stronger economy, which is good, and an effect of that, a byproduct of that, is higher interest rates. And the question is, will those choke off growth or impact equity valuations? We don't think so at this point in time. We think the yield curve is still positive. That's a good thing. So a little bit higher, but
so the yield curve being positive means the short rates are lower than 3%.
Right. Yeah. So and they're discounting a lot of the Fed moves over the next 2 years, and that's a good thing too. So I think the bond markets are backing up as expected, but they're not freaking out. So that's the good news.
Right. I guess it's using the party analogy that we started last time. It's signs that the party's getting on into the night, though.
Right.
So and also the Canadian 10-year rate's a lot lower than the U.S. rate.
Right, and so that's
like 2.3.
Yeah.
Right. Instead of 3, big difference.
And I guess the point being there that rates have backed up somewhat, bond rates have backed up somewhat, but still the Canadian 10-year rate is really very low.
So not attractive enough to
exactly.
to buy them.
Right.
I'm going to stay on the U.S.-Canadian difference for a minute. I got one of our economic guys to write a report. Look at what Canadian household debt was in 2007 versus U.S. household debt versus a percent of their GDP. And the Canadian household was in much better shape in 2007 and 2008 than our U.S. counterpart. We had debt around 82% of GDP, while they had debt just below 100%. And since then, it's completely reversed. Canadian household debt is over 100% of GDP, while U.S. household debt is down at 80%. These are numbers that are a little bit hard to get. It might include corporate. It's not a clean number, but the trend is obvious. And I wondered if that's playing into the fact that the U.S. market's so outperforming Canada.
No, I don't think so. I think that there's consequences from this debt situation in Canada being more severe. It's really trading places in the U.S. where it was in 2008. I think the implications of that are going to be more on the currency side, I believe, in terms of Canada can't handle any higher interest rates. It'll shut the economy down because of the leverage here. And so I think what'll happen there probably is it'll force the Bank of Canada to be more easier than the U.S., and it'll probably impact our currency. So I'd say more downside currency longer term. In terms of the Canadian market being weaker than the U.S. market, the Canadian market's driven by two major sectors, the energy sector and the bank sector. And the U.S. banks have more leverage and more growth in them because Canada did so well over the past 10 years. So we like U.S. banks more than Canadian banks longer term in terms of upside leverage. And in energy, we can't get our energy out of the country. They can make it, but we just can't get it out of here. So that's a bit of a throttle on our energy sector. It's definitely has lagged the other sectors. We think if we get a breakthrough here, if something happens with the Iran issue, you can get a pop and all that could be a benefit. We are moving to an overweight in energy, so we like energy. The problem with Canada, our energy's
locked in.
Yeah,
but to me, it's still, I'm on this U.S.-Canadian difference because in the first quarter, banks actually underperformed. And I just wondered again if the investors are nervous about Canadian households, their mortgages. Of course, in BC here, we have the government increasing property taxes dramatically for the wealthy through speculation tax and school taxes, wealth taxes, empty house taxes. So I just wonder if there's some kind of crunch.
Well, I'd say definitely Canadian banks are more susceptible to this debt, this leverage in the Canadian economy. So there again, it's probably more risk inherent in the Canadian banks versus the U.S. banks. So I'd say
just that statement alone is so it's no more risk in Canadian banks than U.S. banks.
Yeah.
So that's different.
That's different. That's something new.
Anyways, I wanted to highlight that in this video today. The other last difference between U.S. and Canada, big corporate tax cut in the U.S. I'm going to, in a moment, ask you about the earnings there as a result. But corporate tax rates and personal tax rates federally in Canada are going up. So again, a difference.
Yeah, I would say there's a bit of a difference there. I would say in defense of Canada, the U.S. rates, corporate rates are much higher than Canadian rates. They're coming down, they're converging to a global competitive rate where it seems to be they all normalizing that same sort of range area.
Right.
And our tax rates are going up marginally here as well, I'd say. So
and they're mainly personal tax rates.
Mainly personal rates going up. So
talk about the U.S. Tax rates. I mean, they've been profound in their earnings impact. And
yeah, no, we're looking at the Standard & Poor rates going up in 2018, 20%, and 10% next year versus 10 and 10 in Canada as a comparison. So the tax cuts really having an impact. In this quarter, everybody's beat their earnings expectations. It's been another great quarter for corporate USA. So it's definitely having an impact and helping growth and helping this economy move. And I think you're going to see probably 3% plus growth in the second half of this year in the US, aided and abetted by lower tax rates.
So it's so interesting. The market's so smart at anticipating information. The U.S. stock market's consolidating, it would appear, where it was about Thanksgiving time in November. It's been building a base, we hope, we assume, with the earnings coming through. And the valuations are so much better.
Exactly. And I think that's the issue here is that as rates go up, our view, the House view, we're in the last stages of the economic cycle, could go on for another couple of years. During this period, rates go up. Price earnings ratios, or PEs, tend to fall, and they've been falling. But growth and earnings are going up, so you've got those two fighting counter forces. We think that earnings growth will carry the day here and that rates won't go too high because inflation really isn't a problem yet. So it's still looking pretty positive. And money supply growth is still running at 8% year over year in the US. And the European Central Bank and Japanese central banks are still printing money. So we don't see any liquidity crisis. Bond market's not spooked over any kind of inflation coming down the road. And we've got good growth. So we don't see anything too scary out there yet, but we're in a period where when the Fed's raising interest rates, you get more volatility. The market gets a bit skittish and spooked. So there can be more volatility here. There will be more volatility here, but we still think it's worth holding on. And we're focused on the areas that do well at this stage of the economic cycle in terms of the resource sector. We're overweight energy and materials and some technology. We're also overweight emerging markets, which do well in this point in the cycle.
I think that's the important thing to say is normally we would be more overweight Canada given where we are in the global economic cycle, late cycle, but we're not because of things we just talked about. We're more overweight emerging markets instead of Canada.
And those two, Canada is highly correlated with emerging markets, but right now we favor emerging markets over Canada.
Right. Well, thank you, Wayne. Your thoughts are much appreciated. Please call your portfolio managers if you have any questions. We love talking to you, and we'll talk to you next time.